So Tata Motors PV revenue has come largely in line with what the street was working with, but other than that, EBITDA margins and PAT has missed street expectations. In fact, if we look at the consolidated numbers, we have EBITDA decline on a consolidated basis, which is a bit of a negative, and margins on a consolidated basis have come in at 6.6% versus 8.7% that the company reported same time last year. Now, the management guidance for India business is intact. High double-digit volume growth is what they are penciling in for FY27, whereas for JLR, they have reiterated their double-digit revenue growth guidance for FY27. But remember, margins this time around were impacted on account of higher commodity costs, and that is likely to prevail in the second quarter as well. So in the conference call, management has said that they expect margin pressure due to commodity inflation to persist in the second quarter, and largely margins are expected to remain flat in the second quarter of this year. There are 4 new launches that are lined up in the near term, and exports, meanwhile, management outlook remains very strong. Although it is just a small percentage of their total revenue, they are targeting 2x export growth on a year-on-year basis in FY27, although China continues to remain a weak market. We have Citi, which has come out with a report. They are maintaining their sell stance on the stock, but they have lowered their target price from 320 rupees per share earlier. It now stands at 305 rupees per share. They say first quarter results were much below what the street was working with for both India passenger vehicle business as well as for the JLR operations. Severe cost inflation continued to weigh heavy. Outlook, meanwhile, continues to remain very positive for India, but they've gone ahead and cut their earnings estimates, which is why their target price has also been revised lowered. So all in all, weak set of numbers. The management has reiterated its guidance, but the stock will perhaps be in pressure on the back of this.